Hey everybody, Matt from 90th percentile.ca here. For access to more study notes, practice questions, mock exams, and end of chapter question videos, visit 90th percentile.ca and sign up for your free trial today. Link below in the description. For corporate structures and ownership, there's really two key topics in this module. First is, at the very beginning of the reading, the curriculum talks about different corporate structures. So we have, our sole proprietorships, general partnerships, limited partnerships, corporations, and nonprofits. Um, each, structure obviously is a little bit different. Some have their own advantages and disadvantages. One of the biggest differences amongst all of them is liability risk. So whether or not the owner of a company, if it's a sole proprietorship, they're going to be liable for all the losses, while corps are essentially separate legal entities. I would recommend just going over the notes really quickly just to make sure you understand some of the structures. But overall, I don't think that this is really important on exam day, and it's unlikely to be tested. While the second part of this reading is really what's important here, and we're talking about the processes of going public and private. And we're going to go over the four common ways of going public, which include an IPO, a direct listing, an acquisition, or a SPAC, or special purpose acquisition company. And then we're also going to talk about ways in which you can do the opposite, which would be going from public to private. And those are commonly done through LBOs and MBOs. So we'll go over those. We're going to spend most of our time on the second part of the section here, because like I said, this is most important on exam day. So let's just jump right into the questions. All right, first question, we got an open-ended question, which of course we won't see on the exam, but nonetheless, it's useful to describe the different ways that a private company can go public. So there's four main ways. The first one, most people are likely familiar with, is an IPO, or initial public offering. So in an IPO, a company will work with investment banks that act as underwriters, which means that they essentially guarantee the sale of the stock. So if a company is looking to, issue 80% of its shares via an IPO, in the event that the 80% of shares at whatever valuation aren't sold to the general public, the investment bank will purchase the remainder. So it ensures, you know, essentially a kind of like a floor price for the company at which it will raise capital. Proceeds go to the company here, and it's a much longer process. There's a lot more regulatory oversight here. You have to go through, all the kind of typical filings and all that, and it is also pretty costly. So this is usually done for larger companies with, like billion plus valuations. Sometimes you'll see some smaller companies, but for the most part, it's mainly done by larger companies. The flip side of that is a direct listing. So this is the second option. It's actually become more popular in recent years. It's similar to an IPO, but there's no investment bank that acts as the underwriter, which makes it less costly. And basically what happens is a company will list, its shares on the public exchange, and they're not really raising new capital. There's just shares sold by existing shareholders to the general public. So, it's also much quicker generally, because don't really have to go through the investment bank, the whole process, all that. Um, but the direct listings typically result in more volatility on the first day of trading, because there's not really a set market price, like an issue price for the shares. For the most part, they kind of just start trading, versus an IPO where they'll set a price for open on the first day of trading. And of course, you can still have some volatility in the IPO, but direct listings are generally more volatile because there's not really, the investment bank setting the IPO price. The price here is more price decided by market. But like I said, it's gained more popularity recently. I think Shopify actually went through direct listing, so that was kind of a notable one. But Nonetheless, it's an option. Like I said, that's gained popularity. So third third option here is an acquisition. This one's pretty self-explanatory. You could have a private company being acquired by a public company. Something that's going to trade as part of the public company. Like it might, the acquired company might represent like 20% or 10% or whatever of the public company. Um, so that's a pretty, one of the quickest ways to go public. And something similar to an acquisition is actually a SPAC or a special purpose acquisition company. And once again, these have gained some popularity in recent years. And what a SPAC basically is it's a shell company that goes public and they don't have any operations. So there's nothing. There's just a bunch of capital that investors put into the SPAC with the intention of buying a company at some point in the future. There's usually like, I don't know, 6 month, 1 year time horizon before the SPAC is expected to buy something. But when they go public, they don't know, well, generally they don't know who they're going to buy. And you can kind of think of it as a private equity fund a little bit, but just like a public version. That's, might be an oversimplification, but like I said, the shell company investors put a lot of money in. You have the people managing the SPAC who decide what to buy eventually. Um, when the SPAC is listed, it's structured in a way that the shares trade at $10 per share. It's just kind of how it is. And then when the cash is, used to buy a company, um, this price is gonna change depending on what they buy. But before they buy anything, it's just $10 a share, and it might be some small variance from like 9.99 to like 10.01 or something like that, but nothing drastic. Once again, this has gained popularity recently. There's been a lot of, for example, like Chinese companies going public in the U.S. via SPACs. Um, there was also, Trump's Truth Social Media, which I don't even know what ended up happening to that, but they went public via SPAC as well. Um, so this process is once again a quicker way than an IPO because there's already a company that's public, so they just got to get bought out by them. Generally quicker, less costly as well, but you know there might not be as much discovery or awareness about going public if you do it via SPAC versus via an IPO. So overall, whichever method the companies choose to go public, the end result is largely the same. They end up going public, but as you can see, each of these different processes has its own pros and cons. On the flip side of going public, you can also take public companies private, and the two main ways of doing that are either through an LBO or a leverage buyout, or through a MBO or a management buyout. So an LBO, basically what it is it's typically done by a private equity firm. Could be done by strategic companies as well as strategic investors, but typically a private equity firm, and it is mainly debt financed, hence the L leverage. And they'll raise a bunch of debt and essentially use all of that debt to acquire the public company, and then they eventually take it private. So debt finance and by third party investors, usually private equity firms, like I said. Um, LBO is very common in private equity because the more leverage you use or the more debt you take on, it's going to magnify your equity return. So like, let's say a company is got 100 mil valuation and you're going to buy it with 90 mil debt, 10 mil equity. If you're only putting up the 10 mil of your own cash, and let's just keep it very simple. Let's say eventually you sell the company for 200 mil, like not accounting for the principal repayments on the debt, interest, etc. Just keeping it really simple. Eventually you sell it for 200 and wipe out all the debt, then you're getting a 20x return, right? Versus if you bought it for 100 cash, so 100 equity and sold it for 200 equity, it's just 2x. So that's why private equity firms love to use debt to finance these acquisitions, especially when the company they're acquiring has the capacity to repay the debt through cash flow from operations. LBOs were really, really common, still are really common, but they were more common, call it from 2010 onwards. And that's because debt was, really cheap after the '08 recession. There's a lot of capital that can be easily accessed. Whereas now in recent years, you got interest rates going up, so companies got to be more careful with how much debt they can take on when acquiring a company. That's the gist of an LBO. An MBO or management buyout is pretty much the same thing. Um, but here the investors or people that are taking the public company private are management of the company, so they're buying into their own company. Um, they might have some other investors, some third party investors that they're essentially buying out, and they're just going to take the company private. This can be financed with debt here as well. It typically is debt finance, but management might have their own cash that they're using to buy the company out as well. LBOs typically more highly levered than MBOs, but in both cases, the LBOs and MBOs when you're going private don't occur unless the people making or doing the transaction don't believe that the stock is undervalued. So if the public markets are trading at, the stock on the public market is trading at 25 bucks, but whoever's doing this acquisition believes that it's very undervalued, then you know what, they can take the company private, um, re- improve the operations of the company. Also, when you go private from public, there's less oversight. Obviously, like, there's less, reporting requirements. You don't have to do your quarterly, annual reports. Um, there's less overhead costs related to public reporting. So you can take it private, save on the cost for public reporting. The saving on the cost is usually a bigger concern for smaller companies, but either way, it's still a benefit. And then once they're satisfied with how the company is, then they usually take the company public again. And this is how they exit and get their return on capital. They don't have to take it public. They could sell it to another private company. They could, do like a dividend recap, all that. But typically, after going private from public, after a couple of years, the companies will go public again. From the corporate issuer's perspective, the risk level of bonds compared to stocks is, so from the company's perspective, bonds are riskier than stocks. And there's a couple of reasons for this. One, bondholders generally have claims on the assets of the company, so, collateral. The debt payments of the interest and principal are legal obligations. So failing to meet interest or principal repayments will, have consequences. Um, and also increasing the leverage of the company and having to service this debt means that you actually have to generate cash from operations in order to service it. And this is of course different than equity because at the end of the day, debt holders, their only return is their interest percentage plus their principal. This is like for non-convertible debt, right? Um, Whereas equity holders essentially have unlimited upside. But the equity holders, of course, are a little bit have a more risky position because although companies do have a fiduciary obligation to maximize shareholder returns, it's not a legal obligation, right? So the company could go bankrupt, and essentially the equity holders are left with nothing, and there's nothing they can do. Last question here: true or false? Bondholders can become shareholders through non-market-based means. This is true. So by non-market-based means, I mean either going through public or private markets. So this would include you know, in the easiest example, buying shares either in the public or private markets. You could also, exercise options. So, their debt might have like a convertible option to convert into common equity, something like that. So these would be examples of market-based means. But a non-market-based mean would be essentially something like when a company goes bankrupt or they're about to go bankrupt, typically what they'll do is they'll go through a restructuring, which, in my opinion, it's basically a fancy way of saying who gets the remaining pieces of the company. So they're about to go bankrupt. There's like this much equity left. There's this much debt outstanding. Who's gonna own the remaining pieces of the company? So let's say a company is really worth, I don't know, 100 mil, or actually they're going bankrupt. So let's say they're worth 10 mil right now, but they have like 100 mil of debt on the books and like 200 mil of equity. Basically, the restructuring is going to decide what stakeholders get what piece of this 10 mil. So sometimes they could, debt holders could hold on to their debt and maybe negotiate different terms. And then in that case, it would be considered distressed debt. So distressed debt is, just debt when a company's nearly bankrupt. It's like high yield debt almost, but more extreme. Um, but in most cases, the debt holders will actually just convert into a portion of the equity. And given that the debt holders have the first claim on the assets, what usually happens is the debt holders will get the largest piece of the remaining pie, while the equity holders might not get anything really. Like they might get a small piece of this 10 mil, or they might just be completely wiped out for the most part. And they'll be wiped out through dilution when these debt holders convert into equity. So a restructuring is a common way in which debt holders can become equity holders in the event of bankruptcy.